Hey guys, welcome back to the Smash Property Podcast. Today's episode is really about the fundamentals of property investing. We're going to strip back to the bare bones of what you need to do to really build and scale a property portfolio in 2025 and beyond. Welcome back to the Smash Property Podcast. I'm Nick V and this is Akira. We are back for episode number 21.
That's a good number.
21 is a good number. Absolutely. Yeah.
Does it feel like
that.
21 episodes for you?
It doesn't feel like 21 episodes. I feel like this has just gotten more fun as time has gone on. So
I enjoy chatting to you.
yeah, this has been pretty cool. So
I feel like the value that I've kind of taken away is we have these conversations just obviously off camera in our day-to-day really often. So it's been fun watching it back even for myself and just seeing, how our conversations are and how they roll.
Love that.
I love it.
Yeah.
I hope you're enjoying it.
I'm really enjoying it. Leah, like I said, I feel like it's just gotten easier and easier as time's gone on.
Yeah.
And it's been a lot of fun.
Yeah, getting to feel more natural doing podcasts and feeling like, just being yourself. And
I actually do forget that we've got a whole bunch of cameras.
Yeah, sometimes when we're talking. Yeah.
Which is really cool. So today's episode is going to be a lot of fun. We did a bit of prep earlier around the fundamentals of property investing.
Yeah.
This episode really has spawned from a lot of the conversations we have with a lot of beginner rookie investors. And some of the stuff, because we've been doing this for a very long time, as in property investing, some of the stuff I tend to forget, at least in my case, that what I find common knowledge is not actually common knowledge out there.
Yeah.
So this was actually quite good for me to really just go back to the bare bones of what property investing is and what you should be focused on. And I had a couple of conversations during the week. There was an 18-year-old investor that called us from WA. You might be watching this actually. It was a FIFO worker. It really struck me when I was talking about interest rates and he was like, oh, what's that? And so it really just dawned on me that, hey, there's a lot of jargon especially in the property industry. A lot of people like to make themselves sound smart when they really aren't. Hey, you're right there.
Wow. Shots fired.
So I really just thought, you know what? Let's just strip away all the BS and just do an episode on the bare basics. So this is really aimed at beginner property investors.
Yes.
So obviously if you're at advanced level, it might be worthwhile rehashing some of the stuff that we're going to go through. But nonetheless, this is aimed at beginners. And I want you, and I'm going to also, when we go down the path of talking jargon and talking shit,
I'll call you out.
We're going to call each other out.
Okay,
because
I like
this
that.
is really aimed at the beginner episode.
I think so. You caught me off guard there.
Yeah, I think we're like clean up on 5.
No, it caught me off guard because it's true. Sometimes a lot of people convolute conversations and make it more complicated than it needs to be. And that makes property investing, at least from my point of view, more daunting and scary, especially if you're new to it. So, I mean, with hindsight, I feel like it's one of those things when I started my journey, I didn't know all this detail. Nobody explained it to me. To be honest with you, at school, I really didn't understand the whole principal and interest concept and how it applies and how it like varies throughout the cycle of a loan. So all those types of things that, yeah, you and I might think it's common knowledge now. No, everybody understands the bare basics. And I think once you have that, that's the ticket into growing the whole portfolio.
It is. One of my mentors said this often. There's new levels, new devils, and what that means is that if you're a beginner and your baseline level knowledge is 0, right? Mm-hmm. The stuff we're going to go through might seem daunting and challenging. But you're going to get to a point where this stuff is just easy and you know it, like the back of your hand. Yeah. But you then unlock a new level of knowledge where you're like, oh shit, there's another mountain I've got to climb. And so when it new levels, new devils means at every stage of your journey, you're going to be unlocking new things, new challenges to understand, new terminologies, new ways of doing things. But you've got to start from somewhere.
That's right.
And this is where we start.
I love it. And I think the intent, let's keep it simple. Let's get into it. Just go straight into what the basic questions are of growing a portfolio. So the first thing came to mind when we were brainstorming this and thinking about how do we strip it back was, of course, income.
Absolutely.
So I guess maybe, obviously, you need income to buy property because you got to go obviously. But maybe just going a step further and really explaining what it is behind income that makes it an important aspect to, just not just the first property, but the second property, third property, and so on.
It is very important. Now, obviously, like we said, you've got to be earning money to be able to go and borrow money. It's just the simple fundamental of how, the banking system works. Now, ideally, we want to be earning as much money as we possibly can, regardless of whether you're self-employed or whether you're PAYG, meaning that you're working, you're employed with a job, right? You've got an employer. Now, what the banks are going to be looking at is what they're going to be called, what is termed as serviceability. And all that means is how attractive are you as a borrower to the bank? Yeah. Right? So go ahead.
So I think just in line with what you're saying, with the bank, if I were to loan you money, I want to know that you can pay me back.
Absolutely.
That's it. Yeah. I don't want to see you, going and gambling money. I don't want to see you going and buying expensive shoes, clothes every other day, just wasting your money into things that aren't creating value and giving me the comfort that I'm going to get my money back.
Part of serviceability is obviously your income and where you spend it, right? Income versus expenses. What else is also going to help with your serviceability is your credit card, personal loan, car loan. These are all things that impact your serviceability in a negative way, in the sense of if you have a huge credit card with a big balance and, even a big limit, even though you might not have spent that limit, that is still going to impact the bank's ability to give you money. All right. So when we're focused on the very early stages of our property investing journey, we want to be looking at how can we make ourselves look squeaky clean for the banks.
Exactly.
Right. So, you might want to, if you, a heavy gambler or you're going out every weekend on the piss or you're doing whatever, you might want to clean that stuff up first before you then go and apply for a loan with the bank. And timelines, maybe 3 to 6 months, you want to just try and clean things up a little bit.
Yes.
All right.
Yeah.
Now, just rounding out that serviceability piece, if you've got a credit card at the moment that's got a balance owing, you probably want to get rid of that first, ideally if you can, before you then go and apply for your loan. Likewise, if you've got a personal loan, ideally in the perfect world, you want to wipe it out. It's not a deal breaker. If you have a personal loan and you have a credit card and you go to apply for a home loan product, it's not a deal breaker. It just makes it look a little bit nicer, a little bit cleaner if you don't have any of that stuff.
Yes.
In the ideal world, right? So that's what when we talk about income, it's not just how much money you earn, but it's what you do with it. It's also what access do you have to other lending products that you can eliminate entirely, just to clean out your serviceability.
Okay, say for the sake of questions that might be going on in people's head right now, just throw back. Okay, I'm in a predicament where I've been going out for a while. I haven't paid my phone bill for a couple of months. What can you actually do to improve your credit score in very simple terms?
Yeah, I mean, look, we haven't
for your situation. For an example, what did you do?
Let me explain. One of the things that the banks will look at is your credit score, and we haven't spoken about it. So let me introduce the term.
Yeah. Okay.
Now, your credit score is what I was just talking about in the sense of how good you look as a borrower. The bank is basically going to attach a number to that.
Yeah.
Right. That number is going to be anywhere from 0 up to I think it's about 700 or 800. Right. The higher the number, the better your credit score is. Now, every loan product you have, if you've paid your phone bill late, all these sorts of things impact your credit score. So why I was saying to get rid of your credit card and your personal loan, all those sorts of things, was to clean up your credit score. If you're at a point now, to your point, that maybe you're paying your phone bills late. Maybe you're not paying your credit card on time. All those sorts of things.
I mean, you were in that situation.
I was in that situation. I'll talk about that in a sec. But there are things that you can do to slowly clean that up over time. It's not going to happen tomorrow.
Yeah.
But you're going to have to basically pay back the debts that you owe, clean that up first. And then what you want to do is just be paying everything on time, ideally before it's due, right? So you're looking attractive to the lenders out there. Now, in my circumstance, in my late teens, early 20s, I was terrible. Like my phone bills were always late. You know, I didn't have a credit card that early on, but my credit score was horrible. I had personal loans, for the cars I was buying, all that sort of things. It was just a ridiculous situation to be in, right? Over the course of a number of years, I paid down those personal loans. Obviously, cleaned out all of I had toll bills. I had thick fucking notices.
I remember when the paper ones came.
That I just used to hide because I'm like, $20, fuck, I'm not paying that. Like, get out of it. But that stuff hurts you over time, right? So I spent a long time cleaning all that stuff up. And then what I actually did, and it might sound counterintuitive, I actually got a credit card with a very, very low limit on it. I think it was about $2,000 limit, right? Now, the reason why I got that credit card was to improve my credit score. Now, it might sound crazy, but this is how it works. I got my credit card. And in my normal course of, doing stuff in the month, I would put the expenses onto my credit card. Only the expenses that I knew I could pay off at the end of the month. So through the month, tap, tap, tap on the credit card, the monthly bill comes and I pay that thing in full, right? Not minimum payment, in full. So there is zero balance owing at the end of the month. Therefore, there is zero interest paid on that credit card. Now, I did that for a period of time to improve my credit score, right? So by the time I did go for a home loan, I had one of the best credit scores you could possibly get. Took me years to get there though, right?
Yep.
So that's probably a long-winded way of how you can get out of that situation if you're not looking too great with your credit score. You might be sitting there going, I don't even know what my credit score looks like. You can do this for free. Just literally jump onto Google, type in free credit score check. They'll ask you some questions and you can get your score within minutes. You can know where you stand. So I guess, when you're talking about income, there's obviously a point in time where you may be on a reasonable income now. You may be able to go and get an investment loan or a home loan, and you may be able to go out there and buy a property. There will come a time when you hit your serviceability limit. So the bank's going to go, hey, I'm not going to lend you any more money because you can't afford it. So you're going to have to look at ways in which you can improve your income. Now, I started in my banking career, it's 50 grand a year. And slowly over time kept building that income up. Right? If you're out there and you're like, oh, I'm only on 50 grand or I'm only on 80 grand, only on 100 grand. Everyone's going to start from a certain position. But your mindset around your income needs to be, how can I improve the situation? What do I need to do to really get that next promotion, get that pay rise, grow my business, whatever it is, if you are serious about being a property investor. This is probably one of the most important messages in this video around income is everybody's going to hit a debt ceiling, a debt ceiling at some point. You are going to have to work out how you can break through that ceiling when you get there. And increasing your income is the fastest way to be able to grow your portfolio in a quick period of time. Now, this is coming from, us building a portfolio from 0 to 10 properties in 5 years. Me going from 50 grand to 350 grand in my banking career, from the starting position of where I was to, how it's kind of going, there's been a big transition.
Yeah.
That transition has only really come through the mindset that I've had to carry through that period of time to get me to this particular point. So being a property investor, yes, it sounds cool and it is cool, but it requires a mindset shift if you're not quite there at the moment.
Yeah, definitely. And I think maybe the other thing I would say to it, if you're starting off in regards to the fundamentals of this, you don't need a massive salary when you're starting off.
Absolutely not. No.
I think it's important to understand you and I both started this journey I was on a 50K salary.
Yep.
I think I went to multiple banks before I actually got my first loan to see and shop around on what my best options were and the max borrowing capacity I could get. Yep. So I think regardless, you're going to be told no plenty of times from the bank. Regardless of that, you've got to keep going, shopping around. If there's, I say this all the time, but if there's a will, there's a way. So when it comes to borrowing to get yourself into the market, speak to people and work with people who are going to understand your circumstance, your goal, and work with you to get you to that position where you can borrow. And say you can only borrow for 300, 250K, 300. Doesn't mean you can't buy property. There are properties out there in the market. So regardless of your borrowing capacity, you are able to still get in, but being strategic of, being financially competent, I think most importantly, is honestly a critical element to being a property investor. You need to know how you're spending your money, what you're spending it on, and putting yourself in a position where you're future-proofing. So you're not just thinking about the first one. All right, let me think about my career now so that I can continue to build my borrowing capacity as I go down this line.
I remember there was countless times, during my career when I was working at the bank, where I'd get a property and, I'd go to my broker at the time. It'd be, hey, look, you're really capped out here, man. Like there's nothing you can do. And then it would be, my mindset would just flick and I'd go back into, all right, go back to my boss. Okay, what do I need to do to get an extra 10 grand? What do I need to do to get this, to get that, to do this? And I was relentless at doing that. And it's funny because I watch a lot of, successful property investors that have, double-digit portfolios, 20, 40, 50 properties or whatever. There's just a certain mindset, and we've mentioned it before, that grit, right? There's just a certain something that those investors have that get them to that point because it's not fucking easy.
It's not.
Like you don't just get the 10, 20 properties.
Unless you're a trust fund kid or you've got an inheritance, obviously. But I think it's also in those circumstances, it's not easy to keep property. It's genuinely a competent understanding of finance that you need to have and how money is cash flowing in your environment.
Yeah,
because
you kind of just mentioned it if you're shit at managing your own money now, hey, guess what? You're going to be shit at managing your own properties. Do you know what I mean? So you kind of have to, and this is
a big deal.
In the book that I'm writing. I actually wrote this chapter today, which is why it's fresh in my head.
Yeah.
Is you've got to master managing your own money first, which is not difficult to do, depending on how you're wired. But you've got to master that because then when you've got, rental income coming in and there's expenses coming out and all that, you got to be on top of that stuff. You
don't want to stress yourself out. If you don't know what's coming in, what's going out, to be fair, actually, I was speaking to someone and just not understanding your cash flow can keep you up at night, genuinely, because it means that essentially between, trying to build your wealth and then getting stagnated and scared off by, a couple of $1,100 every month, week, whatever it is in your particular situation, it puts you off doing the whole thing. But then if you understand, I don't want to go down a rabbit hole here, but if you understand what that looks like, all right, if, council rates are due in the next 3 months, when do you actually pay that within your cash flow position? So managing your money is essential in this.
So fundamental number one of property investing is your income, your dollars, right? What's coming in, what's going out, what does your credit score look like? How attractive are you to the lenders out there?
Yeah.
What is your credit score? All those sorts of things. The other thing I just want to round this out with is if you're self-employed, because we've spoken with quite a few, for some reason, a lot of people tend to think that, I'm self-employed. The bank's not going to lend me money. That's not the case.
Definitely not.
There are many, many ways that self-employed people can get access to debt, get their hands on, loan products. There's some things with having ABNs for a certain amount of time and all that sort of thing, but there are lots of ways in which you can get into the market as well. So don't put it off thinking, I don't earn enough or I'm self-employed or whatever. That's bullshit. You can definitely get into the market. You've just got to have the right team, have the right broker, have the right accountant, and away you go. Now, so we've kind of talked about, okay, yeah, cool. We've got our money sorted. I've got my income. I've got some savings. I've gone to the bank. Yes, they said I can borrow. Okay, what's the next step now? The next step is now just getting into the market.
Do it.
Right? Don't sit on the fence for 2 years, 3 years. I'm going to wait for interest rates to come back down, or I'm going to wait for property prices to decrease, or I'm going to wait till I save a little bit more. I'm sorry, if you've got that mindset right now, you're not a property investor. I'm sorry to say.
I'm in agreement with that. It's sad but true. I think it's one of those things with property. Someone asked me actually this week, when do you reckon it's going to be the right time once the interest rate drops? I'm like,
I love answering that question. When's the right time to buy, mate? 30 years ago, that was the right time to buy.
But look, I think, sorry, I'm like stuttering, but I think it's one of those things when you're able to explain, obviously interest rates are going to drop. Everybody's serviceability is going to improve. The market's going to be harder to get into. Prices are going to go up. So everything has a consequence. So I think very, very simply, get in as soon as possible. Be aggressive with it if it's something you want to do.
If you want to build a double-digit portfolio, and you want to get to that financial freedom state, you're going to have to be aggressive with it.
And I say this from our personal experience as well.
Yeah.
In the last 2 years, 3 years now, interest rates have gone up, essentially. Prices have increased. At every single point within our journey of accumulating more properties, never have we said to each other, all right, maybe we should wait for a while and just hold. Why is that?
Yeah, I don't think we would be. If you imagine you said that to me, I'll be like, see you later.
Hey.
No, because it's just, I get what you're saying. Like it's
I think important to understand, like, if you want to do something, there's really no excuse not to do it. You can, there's going to be voices back there that are like,
there always is. I remember when we went through that first round of interest rates increasing. I remember thinking, oh shit, is this like, have I overlooked this whole property game here? Have I over leveraged? Have I overextended? If these interest rates go up 1%, I'm absolutely fucked. Like, and I remember thinking that at one point, and then I was like, actually, no, that's just fear bullshit. It's creeping into your mind. Let's look at the numbers here, right? What happens if interest rates go up 1%? What does that look like? When can interest rates go up 1% based on the current rises that were happening at the time? And I remember looking at it going, yeah, okay, look, it stings. Don't get me wrong, because it was taking a nice cash flow and turning it into a horrible one. But then I was looking at, okay, well, let me look at the properties. What is the current rents that I'm getting? What is the rents when the leases are due? Okay, cool. That's going up. All right. I think we're going to be okay here if we can hold out. So it's not letting that fear, that sort of, lizard brain kind of take over and go, into sort of panic mode. We've spoken about income, right? We know we've got to track our income, our expenses, and all that sort of things that we've just spoken about. The next step is obviously getting into the market. Yeah. Right? We don't want to sit on the fence. We don't want to wait 10, 5, 3 years, whatever it might be.
Waiting for it to be built.
Waiting for interest rates to do this or whatever. You just want to get into the market. And what kind of properties do we want to buy?
Existing.
We want existing houses. Why do we want existing houses?
I get my rent. I can negotiate that deal. I can potentially buy it under market value.
Abso-fucking-lutely.
I don't have to wait 12 months for it to be built. I'm just in it.
You're in it to win it. And the reason so let me just recap the reasons why you want an existing property.
I thought I just did.
No. Let me just say this. So number one, you can buy it at a good price, right? You can negotiate the fuck out of it, right? The most important thing that I'm saying to buy an existing property is that you can literally, the day after you settle, You go back to the bank, you get the property revalued, and if you've bought right, you can pull out the equity and you can go again as soon as possible, so long as you can service the debt. If you want to build a portfolio, you want to do it in as quick a time span as you possibly can. You don't want to buy and then wait. I'm just going to see how it goes. Yeah, I'm going to see how I can save a bit more. No, fuck that. You go back to the bank, you get the equity, and you go again.
You're getting me fired up.
If you want to be a property investor, that's what you've got to do.
How do I get my next one?
How do you get it done as soon as possible, right? We went from buying one every year to then buying a couple every year to then buying multiple properties in, a quarter. Yeah. Right? Because it's a game of the longer you are in the market, the more you are going to benefit from being in the market.
Compounding.
Right? The bullshit saying it's not about timing the market, it's about time in the market, right? That's couldn't be more true.
Exactly.
Okay. Now, we just briefly brushed over, buying it below market value. Talk to us a little bit about that. Because you might be sitting there going, yeah, obviously, guys, I want to buy it as cheap as I can, but how?
So what I think is critical to understand is when you're selecting a property, you need to have an understanding of similar properties within that pocket, within that suburb, within that area. So if it's a 3x2, look at other 3x2s. Really understand the plot of land that you're buying and compare it to other deals that have sold recently, sold or up for sale currently, and basically understand what the massive differences are. So once you do that, you're then able to negotiate that deal. So often if it is an older property, you have the capacity to review the property and say, look, that carpet's not maybe that good. This is something that we need to consider in comparison to these other properties. And you can potentially reduce, the amount that you're paying for it. So negotiate.
You've got to be you've got to be able to your point, spot value. You've got to be able to negotiate strongly on the deal. Now, spotting value, to your point just then, that's something that if you don't have the eye for it, you kind of going to have to train yourself. And to your point, you look at recent sales and all that sort of thing. But in terms of negotiation, how do you become a good negotiator? Well, in essence, the person that wins a negotiation is the person that doesn't need the thing the most.
Yeah, you can't be desperate.
Right? So if you're a property investor, you don't have emotions in this game, right? Because your emotions are going to get you caught up and you're going to buy the wrong deal at the wrong price, right? So the number one thing I would say about negotiation is just be prepared to walk away. It's not that good. Deals come up every single day.
Yeah, so it's the abundance mindset. Be able to look at things for what they are. Don't get caught up. And I think if you're getting caught up, it means that you're the one in the lower end of the deal.
You're the sucker.
You're the sucker. And if you're not, that's not easy. I mean, we're making it sound easy, but it is not an easy thing to do because that takes time. You have to review different properties, things come and go. Often I speak to people, they're like, oh, it was up for like not even a few hours and they've already got an offer on it. Like, what is this? It's not uncommon. So having those relationships in the market, and if you aren't able to do it, leverage people who have done it before. Work with people who understand it so that you are putting yourself in a position where you're coming out on top, basically.
100%. The other component to buying buying the property as cheap as you can get it is your offer terms.
Yeah, sorry, that's important as well.
Now, terms can make or break a deal. Sometimes it's not even related to just the price. It's, you've got this clause, you've got that clause, whatever, and you're not tailoring the terms to appease the seller.
Yeah.
Sometimes you're going to have to put terms in there because you're going to have to, and the seller's not going to like it. Man, just go to another deal. Happens all the time through the BA business, right? But putting, as little terms as possible, and really just understanding, what's going to make the seller happy. Maybe they don't want to settle quickly. Maybe they want to delay settlement. Or maybe they do want to settle quickly. So after you're unconditional, boom, settle, done, away you go.
Yep. So these are conversations that you've got to have with the real estate agent to make sure that you're putting your best foot forward. I think the last thing you want to do is hinder yourself on unnecessary reason, like say you want short settlement terms, they want long settlement terms. If it's something that is worth kind of, discussing and talking about, do it because it'll put you in a good position.
Absolutely. All right. So we've got income. Yeah, cool. We know what we need to do there. We've got getting into the market. All right. We've explained that just focus on existing houses if you can afford to do so. Buy the house as low a price as you can possibly get. And we've told you how you can actually do that. And if you can't, there's professionals, buyer's agents that can really help you get into the market. What you want to be focused on is buying, because you're going to be like, okay, cool, guys. Well, fine. I'm going to buy a house and I'm going to get it as cheap as possible. Fucking, groundbreaking stuff there. But there's a couple of things that you're going to have to be focused on with buying in an area that's growing in value.
Yes.
And buying in an area where the rents are increasing. Now, how can they do that?
Data and understanding. There's a few things actually. So one, data, understanding, infrastructure, understanding what's going on in the workforces. Pick up the phone, talk to a property manager, real estate agent, locals in that area to make sure that you are across and aware of that actual pocket that you're looking at, especially if it's interstate, or leverage, professionals who actually know.
Absolutely.
So essentially, I think every single one of our properties have gone up in rent over the period that we've held them. And I think, to your point, that is a critical element to ensure that, whilst, your net worth and your capital is growing, you can actually hold the property. You're not having to sell it off because you can't manage it. Yeah.
And it's the age-old capital growth or cash flow. Well, you kind of need both, really. You want the growth first. That's primarily what you're looking for, because growth is wealth building. That's the stuff that everybody wants out of property. Now, to get the growth, you need the cash flow to service the debt along with your income and all that sort of thing. Now, we want to be focused on growth areas, and to your point, yes, data is important. You might be sitting there going, "Well, fucking data. How?
What's
and
data?
Where do I get that? And what do I?" There's a Google's your best friend here.
We're in an amazing time.
There's the best data is paid data. There's no doubt about it. But we have built multiple property portfolio using data that's freely available online out there for investors. All you got to do is do a bit of research on Google to get it. You want to be looking at, demographics. You get that from, Australian Bureau of Statistics and a whole bunch of other areas.
Honestly,
there's a ton of information.
You and I think maybe just to make this a more personal and first-hand experience and share stories from what we've experienced. When we looked at properties and when we were researching areas on properties that we wanted to buy, I remember just sitting there, jumping on the ABS websites, comparing different suburbs and putting it on a tracking sheet. Just doing simple things like that, looking at, the general demographics, looking at Seek and understanding what employments were going on, what were the average incomes. Sounds boring, but it is like, if you want to play this game and do this, it's important to treat it like a game, make it fun for yourself and see, oh, whoa, there's so many suburbs. Let's make a game out of it and see.
I might sound like fucking nerds here, but that was actually a lot of fun. And that ultimately was the birth of the buyer's agent business, whether we, can see that or not. So there are tons of resources out there where you can see what's happening in a particular area and where it potentially might grow. Council websites, state government websites, all that sort of stuff are great. Now, growth is important. Rent increases are probably, I would say, arguably just as important as the growth, or you might hear the term rental yield. That just refers to return that you're getting in terms of the rent return versus the purchase price of the property.
You got to remember net versus as well.
Gross is basically the yield before expenses. Net is the yield after expenses. Now, you're going to always hear about gross yield is when you're talking about residential is what's quoted most often. The reason why it's important that you have your rents increasing is, for example, you buy a property day one, it's negatively geared. generally speaking, at the moment, if you're buying
at
a
these
house
interest rates,
with interest rates as they are, it's most likely going to be negative geared if you're putting down 20%.
Yep.
Now, over time, what I've actually seen with pretty much every single property we bought is there's generally a 3 to 5 year period where the property is negatively geared. And at that 3 to 5 year mark, it flips because the rents are slowly but surely increasing every renewal. You're holding that property for that whole time, obviously. Now you want that rent obviously increasing so that at a point in time, that property is no longer negatively geared. It's actually positively geared and it's putting money into your pocket. And because you've bought in the right market, it's also growing in value. So you can double dip the capital growth and cash flow at the same time.
Yep.
Very important.
Very, very important. And I think maybe just a glimpse into the future, which I think is always important to do. Okay, that's 5 years where it's going to start becoming neutral, positive. Imagine 30 years from that point.
Can't believe it, yeah.
Your debt position will be decreased completely, obviously, if you're not interest only paying off that loan. And then your rental income will continue to go up. Imagine that. Like, it's something that, it's only once you experience it and understand it that you really understand, okay, this is actually genuinely another stream of income to supplement my primary income on a PAYG or, business income.
Yeah, absolutely. And so if I'm sitting here and I'm listening to this, I'm like, all right, cool, guys. Well, I've got to earn money and I've got to earn as much as I can and I've got to have a good credit score. There's the things that you mentioned that I can do to improve my credit score. If I'm self-employed, I'm not out of the game. I can still get in. If I've got, a low income, I can still get in and increase that over time. You're telling me to buy. You're telling me to get into the market as soon as possible. You're telling me to buy existing properties. You told me a little bit about how I can actually buy a property for as cheap as I possibly can. You've told me how I can do a bit of research and find the right markets. You've told me I need to be focused on buying growth and then eventually, the rent is going to actually go from negative to positive. Cool. I'm shit scared though about interest rate. What if they go up to 10%? What if they go up to 15%, 17%?
17%.
I'm worried about inflation, all those sorts of things. Now, let me tell you something.
Go for it. Go for gold.
Let me tell you something. As a property investor, inflation is your friend. Property really has only gotten to where it is in terms of price because of inflation. The building hasn't gotten more expensive.
Yeah.
Right? The land is the most valuable component of property. And what has driven up price the most is inflation. So you look at the market over the last sort of 2 years when we've had this rampant inflation going on above, the 2 to 3% target, right? 2 to 3% target, what it should be. What's also happened in that time? Property prices have gone to record highs. Yes, there's other factors involved, the immigration policy and, the hundreds of thousands of people that have come here. But fundamentally, what has increased price the most is inflation. So the reason why inflation is good is all the things that I just mentioned. That is the number one driver of property prices and the perceived value of property going to increase 100%. Over time.
I think in this world, honestly, there's not many things that once you purchase it that it actually goes up in value. There's very few things, to be honest with you. Obviously, other than collectibles, houses, maybe gold. Really?
Yep.
What else goes up in value once you buy it?
Yep.
You buy a car, take it out. If it's not a collectible car, it's gone down in value. You buy a computer, it's gone down in value afterwards. Yep. A house is one thing. If you buy it in the right market and be strategic, it'll go up.
It is. Now, you might be sitting there going, yeah, okay, cool. But I'm shit scared of all this debt. What am I going to do? I'm going to have, millions of dollars worth of debt. One of the reasons why inflation is your friend here is that debt becomes irrelevant with inflation. So what do I mean by your debt becoming irrelevant? Your debt's still going to be there.
Yeah.
Right?
I'm going to ask you some questions so that you can explain this further and further.
But what I mean by debt being irrelevant with inflation is that you pay the debt you have today with tomorrow's inflated dollars. Okay, super important. A very important concept to think about and understand. And that's one of the reasons why I'm of the opinion, personally speaking, that I wanted to get my hands on as much debt tied to income producing assets as possible.
100%. So we're getting deep into this episode. I really do think that's its whole new kind of topic. Let's maybe do that as the next one. So I think, talking about inflation and understanding that concept, you explain it extremely well. So let's keep that as a full package on another episode, because that's going to be a juicy one, I think. It's most people understand what it is, but I think if you're new to property and you really want to get into the deeper levels of that, they're all intertwined in terms of property investing, interest rates, like inflation. All these terms are all a cohesive kind of system that is important to understand. And I think once you get these core concepts, it puts you in a really good position to keep kicking forward and getting more property.
Absolutely. All right. So get your income sorted. Understand your expenses. Make yourself attractive to the banks. Look sexy. Put that nice little,
put your
outfit on and go straight in front of the banks. Just kidding. Get in. Don't wait. It's just gonna. You're costing yourself money and time. Really,
you actually are costing yourself money.
So get in. We've told you what you need to buy. We've told you how you can buy it. We've told you how you can research the markets. We've told you to not be concerned about debt and having to pay that back as it becomes irrelevant with inflation. That is a very baseline fundamentals of property investing. And there's a lot of stuff in there that can be literally its own topic for months on end, because we can make it very complex if we want to. But we tried to keep that as simple and as friendly as possible. Yeah. For brand new investors, and maybe even some existing investors might get
it's
some
important. I think when we were sorry to cut you off. I think we were reviewing this topic and going through the fundamentals, and it's a nice reminder, even as an experienced investor, to always come back to the fundamentals.
Exactly right. Thanks so much for tuning in this week, guys, and supporting us on all the channels that we have. Until next time, thank you so much for watching. We'll catch you soon.
Thank you.